Assalamualaikum. My name is Nur Shahira binti Salim. My matrix number A24832669. In this section, I will briefly explain deposit risk in Islamic banking. Deposit risk refers to the possibility of unexpected withdrawals by depositors, which may affect the bank's funding sources and financial stability. In Islamic banking, deposits are based on Sharia-compliant contracts such as wadi'ah, qard, and mudharabah. There are three main characteristics of deposit risk. Firstly, early withdrawal risk occurs when depositors withdraw their funds before maturity. Secondly, rollover risk occurs when depositors do not renew their deposits after maturity. Thirdly, run risk involves large or simultaneous withdrawals. Deposit risk is important because it helps protect bank funding stability and strengthens Sharia-compliant risk management. Overall, understanding the risk enables Islamic banks to manage deposit funds more effectively and maintain financial stability.
My name is Jordan Sham, matrix number A24829669. I will explain the importance of deposit risk in Islamic banking ecosystem. First, maintaining liquidity stability. Large of simultaneous withdrawal can cause cash shortage and disrupt daily banking operation. For example, in Maybank Premium Mudarabah account, customer act as wrap out amount while the bank as a mudarib to invest the fund in Sharia compliant activity. Second, preserving depositor confidence and trust. If depositor lost confidence, the bank funding base may decrease, which can limit its ability to providing financing and other Islamic banking activity. For example, CIMB Islamic TIA, principal and return that are not guaranteed, and the investment account is not protected by PIDM. Thirdly, supporting sustainable growth of Islamic banking industry. A stable deposit base allows banks to make reliable financing decisions and allocate funds to productive Sharia compliant activity. For example, Bank Islam signed an MOU to provide 100 million in Sharia compliant financing to PAAB contractor in 2026.
Assalamualaikum and hi, my name is Nur Amirata Shabita Begani and my master number is 848291. So today I will present the main factor that affect deposit risk. First, the first factor affecting deposit risk is the decline in the bank rate of return on profit. The main cause is that lower return compared to competing bank may encourage depositor to withdraw or transfer their fund, especially to seeking higher return. Islamic bank also depend on return from Sharia-compliant financing and investment activity to maintain competitive return. For example, in Malaysia, lower return offered by Islamic banks compared to conventional competitor can increase the risk of deposit outflow, as highlighted by Ashraf and Zakaria. The main factor is an increase in deposit withdrawal and liquidity risk, as well as DCR. This is because Islamic banks may need to use part of their profit to maintain competitive return and retain depositor. Therefore, maintaining competitive return is important to ensure depositor retention and depositor stability. In short, lower return can lead to deposit outflow, which increase liquidity risk and DCR. Second, the next factor is the increase in the non-performing financing or NPF ratio. So the main cause is that higher NPF reduce the bank earning and cash flow while increasing the need for provision. For example, in 2006, Bank Islam Malaysia Berhad recorded an NPF ratio of 20%, required 1.48 billion in provision and resulting 1.29 billion net loss. So the bank distributed 3,071 million in profit sharing to depositor to prevent a bank run. Overall, the main impact is the weaker financial stability and depositor confidence, which can increase the risk of significant deposit withdrawals. And that's all for me. Thank you.
Assalamualaikum, my name is Nur Shazana binti Muhammad Fazli. My matric number is A248346. Moving on to 3.3 deposit contract structure risk. This refers to the risk arising from the type and structure of deposits, especially when a bank relies heavily on short-term deposits or a small number of large depositors. The main reason is that sudden withdrawals can reduce the bank's available fund and create liquidity pressure. For example, if a large corporate depositor move its fund to another bank offering better returns, the Islamic bank may face difficulties in maintaining sufficient liquidity for its financing activities. As a result, the bank may face higher funding costs, limited financing ability, and increased deposit and liquidity risk. Therefore, maintaining a stable and balanced deposit structure is important for effective liquidity management. Next is 3.4, weak Sharia compliance and reputation risk. This occurs when an Islamic bank fails to comply with Sharia principles, which can affect customer trust and the bank's reputation. This is important because customers expect Islamic banks to operate according to Sharia requirements. When non-compliance occurs, customers may lose confidence in the bank. For example, if an Islamic bank charges riba or interest instead of using a Sharia-compliant financing structure, this can become a Sharia non-compliant issue. As a result, customers may withdraw their deposit or transfer their funds to other Islamic banks, leading to reputational damage, reduced profitability, and greater financial pressure. Therefore, strong Sharia compliance is essential to maintain customer trust and protect the bank's deposit base.
My name is Nur Najia Ansha binti Shafal Anwar. My metric number is A2483465. Now I will explain the first and second impact of deposit risk. The first impact is the amplification of displaced commercial risk. This occurs because low return may encourage IAH to transfer their funds to bank offering high return. For example, Bank Muamalat offer a profit rate for 1 month up to 2.25%, meanwhile MUFG Bank offer 2.85% for 1 month up to 3.25%. The impact is that Islamic bank face pressure to maintain competitive return and existing fund. The second impact is capital loss exposure for investment account holder. This occurs due to changing market condition, depreciation of invested asset, and increasing industry competition. For example, if IAH invests 20,000 ringgit and the investment experience a 10% capital loss, the investment value will decrease to 18,000 ringgit, resulting in 2,000 ringgit capital loss. The impact is IAH receiving low return and loss of the original capital that will be used in the future.
Now I will explain the third and the fourth impact of depository, which are the manifestation of fiduciary risk and systematic instability, and the triggering of withdrawal risk. For the third impact, fiduciary risk is associated with poor governance and risk management in managing investing funds. For example, poor investing selection and monitoring could result in financial losses. As a result, this financial problem could propagate across interconnected banks and increase systematic instability. Moving the fourth impact, high reliance on a short-term and liquidity deposit increase liquidity pressure. For example, customers would withdraw deposit while the funds are invested in less liquidity assets. This creates a liquidity imbalance and could increase withdrawal and solving risk.
Assalamualaikum, I'm Aina Shazwani binti Muhammad Izzat Azrai A24A3113. Today I would like to talk about risk management strategy and critical reflection for enhancing deposit stability in Islamic banking. First, our strategy is the implementation of the Profit Equalization Reserve or PER mechanism. PER acts as a return smoothing mechanism by setting aside a portion of investment profit during strong financial period. When earnings decline, the accumulated reserve can be used to support return for IAH. This helps maintain competitive return, reduce fluctuation, and mitigate displaced commercial rates or DCR. For example, MBank Islamic previously used PER to manage fluctuation and stabilize return to depositors. Under the previous framework, up to 50% of monthly gross income could be allocated to PER with a maximum of 30% of the Islamic banking capital fund. However, BNM discontinued PER in 2018 to promote greater transparency based on actual realized profit. Overall, this strategy can reduce return volatility and mass withdrawal rates by maintaining stable and competitive return to IAH. At the same time, it can strengthen the bank financial resilience against adverse market and microeconomic conditions while managing DCR. Next, our second strategy is the establishment of Investment Risk Reserve or IRR and Sukuk. IRR acts as a financial buffer against unexpected credit and investment losses.
At the same time, asset-backed sukuk help restructure the stretched cash flow and support financing through tangible assets. Together, these instruments help manage rising non-performing financing or NPF while protecting investment account holders from significant losses. For example, Align Bank Limited or ABL Islamic Banking maintain an IR to manage credit and market risk. The IRR is funded from the profit available to IAH after deducting the Mudarabit share, with contribution generally capped at 1% unless otherwise directed by State Bank of Pakistan. The funds are then invested in Sharia-compliant SLR-eligible securities such as sukuk. Overall, this strategy helps offset unexpected credit and investment losses while protecting IAH funds from significant erosion. It also reduces the impact of rising NPF and strengthens the bank's solvency, capital resilience, and financial stability.
A very good day. I am Izura Isabel and my matrix number is A24A3022. Today I'll be bringing you through 5.0, which is the risk management and critical reflection for deposit stability. Let's look at 5.3 first, which applies the strategy of Wakala Bi'al Istithmar. This strategy is applied because uncertain and fluctuating investment returns may cause depositors to become dissatisfied when the bank's return is lower than competitors, leading them to withdraw or transfer their funds. Wakala Bi'al Istithmar provides a clearly stated expected profit rate and investment terms from the beginning, giving customers greater return predictability while still ensuring that the return is expected rather than just guaranteed. Therefore, it helps reduce withdrawal pressure and deposit instability caused by return uncertainty and market rate competition. Let me show you an example. Bank Negara Malaysia is one of the examples where 50,000 ringgit is put in as an investment. 5.36% from the 50,000 ringgit, which is equivalent to 2,680 ringgit, becomes gross return. Agency fee is 0.1%, which is 50 ringgit. Expected profit is 4%, which is equivalent to 2,000 ringgit. The remaining 630 ringgit may be taken as an incentive if agreed in advance. The 4% is expected, not guaranteed, as actual return depends on underlying asset performance. Now, what impact does this give us? Firstly, it provides price transparency and customer expectations are met with improvement. And it also reduces the needs for banks to sacrifice their own profit to maintain competitive depositor returns. Moving on to the next strategy in 5.4, which is the Sharia audit and governance, we can see that this strategy is applied because Sharia compliance problems may occur during the actual operations of a deposit product, even if the product was initially approved by the Sharia committee. Errors in investment activities, profit calculations, agency fees, or fund utilizations may create Sharia non-compliant income, financial losses, and reputational damage if they are not detected quickly. Therefore, regular Sharia monitoring and audits help identify and rectify problems early, protecting depositor confidence and preventing withdrawals caused by loss of trust in the Islamic banks. For example, we can bring back the previous strategy, which was Wakala Bi'al Istithmar. In this context, the auditors usually verify funds that are invested only in Sharia-compliant assets, where 5.36% actual return is correctly calculated, 0.1% agency fee is correctly charged, and the 4% expected return is not automatically guaranteed. Errors should be detected and rectified immediately before affecting many depositors. The impact to this is that it detects Sharia non-compliance early and prevents financial losses and purification costs.
In conclusion, the main factor identified is the decline in the bank's rate of return on profit, which may encourage depositors to withdraw their funds. To manage this issue, Islamic banks can implement the Profit Equalization Reserve or PER mechanisms to maintain stable returns. However, this may amplify displaced commercial risk or DCR as banks use part of their profits to maintain competitive returns. Overall, effective return management is essential to maintain depositor confidence and financial stability.